So tonight, guys, as far as trading goes, I thought I'd go through risk and reward, because I think the technical analysis side of trading's not that technical. Anyone can learn it. And the risk to reward, you know, how much risk there is, how to mitigate the risk, minimise the risk, maximise the reward, so to speak. That becomes one of the more important things to learn about trading. So let me bring up a chart, get everyone's faces out of the way. We can all see that, yeah?
Yep.
And I might just do this as a quick example. We'll pretend like this is a live trade. So we've got the polka dot chart up. So if we saw this, you know, it's not hard to see that, you know, it's in an uptrend. That's all pretty obvious. You know, we've got highs, higher highs all the way through. We can draw a trend line somewhere here. Yeah, we could draw a trend line through there like that. Make sure we know it's in an uptrend or everything. What would I do if I, you know, it doesn't matter too much. I didn't want to get into that, but we've got a trend line. My point is we've got an uptrend happening. So what we're looking for is, you know, a good place to enter. And because it's an uptrend, we're going to be looking for a long position. So we're trading with the trend. So we just got to wait until we get some confirmation that it's a good time to enter. So what we're looking for would be like a morning star. Sorry, I was just saying something on my screen. I was trying to work it out. We're looking for a morning star pattern down the bottom, or a big bullish engulfing, or one of those candle setups to indicate that the market has finished its downward retracement and then is moving back up. So like in this case, you know, we might have thought that it had bounced off the trend line and we might have placed a trade here, but it wouldn't have worked out. But I'm just pretending like this is where the market is now. And so what I'm using here is a feature I haven't probably mentioned about TradingView, and it's only available to, you know, if you're paying for TradingView, if you've got an upgraded account. But this isn't the current. This is, you know, this is the 3 o'clock on the 8th of August. So, you know, it's a few days ago where we are here. So the market has continued on since then, but I've backtracked it and deleted all that. And what I can do is just click this play button here and it will start moving forward. It's just got the next candles come in, another candles come in. So, you know, so far it's come down and we've got, you know, it's almost a hammer, but it's definitely like a doji candle here. And now we've got the next one just starting to come up. But because it hasn't come all the way up further than this red one, it's not full confirmation. It's not a morning star setup pattern yet because it hasn't gone higher than the red one. So I'll just go a bit further. Wait for the next candle. So it's come down. Still coming down, going up. Just sort of consolidating there a bit. So now that it's sort of consolidated here, now that we've got this big green one coming up here, it's a bullish engulfing because this is just a little red one. So I've got a bullish engulfing. So right about here would be a reasonable spot to start looking at maybe placing a trade. So we'll just draw a line there. I just like my trade ones to be yellow. So we're looking at placing a trade right there. What we now need to do is work out, you know, how large a trade should we take out? That would be the first thing. And then we're going to want to work out where to put the stop loss and where to put the take profit. Now, I think it's best to work out, so we've worked out where we want the trade to go. Now, we need to work out where the stop loss should go. So I've placed this trade based on the fact that the market has come down and bounced and is now moving up. So if the market was to come down again and get lower than this candle here, then that would mean my analysis was wrong, or it just simply isn't going to play out. And they don't all play out. That's why we have the stop loss. So I would place a stop loss a little bit below where this candle, like where the wick was. So that's where it finished. I would go a little bit further down just to be sure. And that is where I would place my stop loss. So that would be my stop loss. And now my take profit, because it's in an uptrend, what we're expecting, you know, based off that quick analysis, what I'm expecting / hoping for is for the market to move up and make a new higher high. Because if this uptrend is going to continue, it has to form a new higher high, which means it's going to go higher than this. So you could, you know, just guess maybe right about there is where the next high might be. But to be safe, I would like to go just, you know, no higher and maybe a little bit lower than this last high point. That's just to be safe. I'm expecting it to go higher, but just to make sure you don't just miss your take profit by a small margin while you're not watching, the safest way to do it is to just come a little bit down from this high point. If you're somebody that's in a position to monitor your trades a lot more, then, you know, you could put it a bit higher, but once it got up to around where this line is, you could just monitor it closely. And if it looked like bouncing and coming back down, you could just manually close your trade and make sure you took a profit still. But that's where we're going to place our take profit. Because most people, especially when they first start trading, they don't have the luxury of sitting here staring at a screen. And once you get good at trading, you don't want to do that anyway. So that's sort of roughly what we're looking at. Now we have this little tool here. And if I click that right on the trade line, so that's where I place a trade, I'll click that there and I'll drag the red shaded section of it down to where my red line is. And then I'm going to drag the green shaded section up to where my take profit line is. Just hang on a sec, guys. Zoom recording. So I just had to duck out, guys, but just to get back to where we were, we've put this this here drawing tool. So we've got this one if you're going to be placing a long order, and you would use this one, which is just in reverse if you're going to be doing a short order. But we click it to start it on the trade line, which is my yellow line. We drag the red shaded area down to where our stop loss should be. And then we drag the green shaded area up to where our take profit line is going to be. And now if we have a look, our risk to reward ratio is 1.89. That means for every dollar we're risking, we are potentially going to make $1.89. There's no exact set ratio that you have to have. You wouldn't want to go down to just one, because every dollar you risk, you're only potentially going to win $1. So you'd have to win, if you went 150% of your trades, then you would just be breaking even. And it's much better if you can get, I like to get up around about, you know, what we've got here, 1.89 or 2. If you can get 3, that's awesome as well. Just means you've got to risk less money to potentially make more. So what we can do also is we have this little ruler drawing instrument here. If we highlight that and put it on our trade line and click, and then drag down to where our stop loss is, you'll see that that means that the value of this particular token, which is DOT, if it moved from the yellow line down to my stop loss, it would have moved 5.18, it would have lost 5.18% of its value. You can also see that written just here. Well, it's 5.32, but close enough. So that particular percentage is going to help us calculate what size trade we're going to take out. Now, I know this sounds like a long process, but you can do it quite quickly. And when you get the hang of it, you don't necessarily have to go through the whole procedure. You can pretty much just know what you've got to do. But just trying to explain how it works is, and this is another figure that's going to just change depending on your own risk appetite. But if you're new to trading, I would suggest that any trade you take out, you should have the stop loss in a position where if you hit that stop loss, you will lose no more than 1% of your account balance. So if you had a $1,000 account balance and you hit your stop loss, then you would want to lose no more than, what did I say, $1,000. So you wouldn't want to lose any more than $10 on that trade. $10 being 1% of $1,000. So we know that from here down to here is 5% of that is a 5% drop. So if we were, we'll just do this nice round figures. So if we were doing a 10 times leverage trade, then from here down to here, being just over 5.3% drop in value, if it's on a 10 times leverage trade, that would equate to 53.2%, so just 10 times that, 53% loss of however much capital we're allocating to that trade. So if we're trying not to lose any more than 1%, then we would want this figure to be no more than $10. So if we placed a trade and we allocated $20 to that trade and we lost 53% of it, that would mean we'd lose about, well, it would be just over $10, but about $11. There's plenty of calculators out there you can grab to calculate this precisely, but I'm just going to do it on my phone. If I had $20 in there and the market moves down 5.32%, that means that I would have lost 53.2%. That would be $10.46 that I would lose, which is just a little bit over 1% of my $1,000 account balance. So that's how I'm determining what size trade I should place. Now, if you're more experienced and you get a very good win ratio, because you know what you're doing with trading, your win ratio is most likely going to be a lot higher than somebody that's new to trading. So you can probably be a lot more certain and have a lot more trades hit their take profit than somebody new. Somebody new is probably going to have more hit their stop loss than they are going to have hit their take profit. In that case, you can risk more than 1% of your account. Some traders risk a hell of a lot more than 1%. But I think if you're only risking 1%, especially to start with, you're quite safe. That would mean you'd have to lose 100 trades in a row in order to blow your entire account balance. And, you have to be, the worst trader in the world, plus the unluckiest guy around in order to lose that many trades in a row. So does that make sense so far, guys?
Yep.
No worries. So the higher you can make this risk to reward ratio, the larger you can make this trade and still only risk 1%. So the stop loss has to go here because it's lower than this low point. In my opinion, that's not something you can really change. But let's say, for argument's sake, that we were able to place a stop loss, we're able to place our stop loss a lot closer. We could move that up to there. I wouldn't do that, but you could. Then we now have a risk to reward ratio of 4.1. And the market's only dropped down 2.46%, which is sort of half of what it was dropping before at 5.3. So we could make the trade size twice as large. So let's do that. We'll make the trade size $40 instead of 20 like last time. Because if the market drops down to here, we're only going to lose 24.6%. So now we've got, instead of having a $20 trade, we've got a $40 trade. And if we hit the stop loss, because the stop loss is much closer, it's only $9.84, so just under 1%. So the bigger that risk to reward ratio, or the smaller the distance between the trade and the stop loss, allows you to take out a much larger trade. And then, you know, you take profit. You can literally, like with the stop loss, there's a certain position, there's not much variance in where you should place that. If you take profit, it's up to you. As I said, the market's in an uptrend, so I feel very confident that it will go higher than where I have my take profit at the moment, higher than this point here. But just to be safe, I'm just keeping it down here. So if I go to sleep or I go to work, I'd hate to come back in the morning, you know, wake up in the morning and find out that the market, you know, the market had done this, and it had come just to there, and then it had come down here and hit my stop loss. So almost hit the take profit, but not quite. And then you hit, by the time you wake up, you hit your stop loss. That's why I wouldn't want to have my stop loss. Oops. That's why I wouldn't want to have my stop loss right up here, because of the chance that I could just miss it. So I keep it down here a little bit closer so that I do just hit it and take that profit.
Les, wouldn't you put in a trailing stop loss if you're not going to be able to watch it?
Well, trailing stop losses can be good. They do have their uses. Trading crypto, though, depending on what platform you're on, the trailing stop losses, sometimes they don't have that feature, and sometimes it's a little more complicated, which is fine if you've learned how to do it, but it is a lot more complicated than doing it on an MT4 platform, I find anyway. And also, if you put a trailing stop loss on, you've got to have it back far enough that, okay, so if you had a trailing stop loss and you had it too close, when the market did this little dip here, it would hit your trailing stop loss, but then it would have went up and hit your take profit, but you don't have that trade on anymore because it hit the stop loss. So trailing stop losses can be good, but they can also make you miss out on the bigger profit. It's very hard to have a trailing stop loss in exactly the right position. Too close and you get stopped out when you don't really want it. Too far away and there's not much point having it, because the trailing stop loss might only be about here by the time the market gets to take profit. So it's not really protecting enough anyway. So that's, I've got nothing against trailing stop losses. I do use them, but you've just got to be aware that sometimes they're more trouble than they're worth. Okay, so let's press play and see how this trade would have played out. You know, we've done our analysis, we've placed a trade, we've worked out our trade size, set take profit, stop losses. Let's just see what happens. I've got to press play properly, I guess, don't I? All right. So we've got, ooh, that's looking good. Oh, Rod just hit his trailing stop loss. Nearly got to our take profit. This is a problem. If you're staring at your chart when you've got a trade on, every time it does a dip like this, you want to get out while you've got profit. So like, let's just pause it there. Oops, just pretend that green one didn't happen. If you were watching this, you might go, oh no, the market's turned around. I might just cut my, get out here. I'm still going to take nearly half of my profit I was hoping for. Get out. And you'd take profit and that would be fine. But if you weren't watching and you just let it play out. Probably just go down now. I can speed it up a bit. This is exciting. It's like really trading. I'm hoping to win some money here. Oh, I might have just hit my take profit then. Well, actually, originally my take profit was just a bit higher, wasn't it? It was there. I'd moved it while I was talking to you, so we haven't hit it yet. But it sort of followed my little squiggle. Let's hope it doesn't continue to follow it. Sometimes it only takes 2 candles and you hit your take profit. Other times it takes a long time. So there we go. We can pause it now because we've hit our take profit and all's good. But this is a very handy feature on TradingView because you can just, like trading, if you just bring up a chart and you go back and you do all your charting up in hindsight, it's very easy to trade in hindsight because you can see what the market does. But with this, you can just go and start anywhere and then just play it. You can pause it, do some TA, turn it on again and see if your TA would have played out correctly or not. Probably one of the most valuable reasons to upgrade to, a paid version of TradingView. Just hang on a sec again, guys. And yeah, so you can, instead of in hindsight, it's like doing it live and real. But what I would suggest you do though is, say you can't cheat because like at the moment, this is where the market is now. And so if I just deleted that, I already sort of know, even if I only just got a quick glimpse of it, I already sort of know what the market's done. So the best way to use this feature is to scrunch it all up together like that. So you really don't know what the heck's going on. And then you scroll back a fair way. And then this is how you turn it on. You click that there.
Where'd you click?
See those,
Oh, yeah.
The rewind feature, if you're old enough to know what rewind is. A lot of young people wouldn't have a clue. And then you just pick wherever, and you just click on that. And that's just going to delete everything to the right of that. And then you can zoom it back up. Find where it was. There we go. And now we have a chart. Except there's a little bit of my TA there, so I know the market goes up there. But, if I didn't have these lines there, now we would not have a clue what the market was going to do from there. So we could do our TA, and likewise, we'd know it's in an uptrend. So, we'd sort of know that the market was going to go up and down a bit. That's how it would play out. And then we can, you do a proper TA and have a think about it, maybe place a trade on paper based on your TA. And then you can just come through here and click play and see what the market would have actually done, Right. Very handy there as well. But one more quick thing as far as risk to reward goes. Obviously, speak up if you're not understanding some of it as well. But if just let me share my whiteboard here. If you're, as I said, if you're only risking 1% of your account, then you've got to lose 100 trades to lose your entire account balance, and that's even for a novice trader. That's just not 1,000, 100. But that's just something that you're not going to lose that many trades in a row. So it just makes it nice and safe. And even if you've got $1,000 account balance, as we're talking about before, and you lose a trade, it's only $10. It's not a biggie. I mean, you could have $100 account, and if you lose a trade, you just lose $1. Now, that's not really going to upset too many people at all. It's only when you start playing with money that's big enough to make you respond emotionally, so you're scared to lose it, or you get too excited if you're making it, that you start to trade by your emotions and not by your technical analysis. Now, let me see how I can do this. How we're talking before about the risk to reward ratio, if you can have a risk to reward ratio of 1 to 3, let's say, that's a pretty good profit. That means that if you put $100 into it, let's say you've got, let's say we've got a $1,000 account, and we find a trade, we're going to risk 1%, which we know is $10, to potentially make 3%, which would be $30. So let's say, for argument's sake, we win that trade. That means we just won $30. That makes sense, yes?
Yep.
Then we find another trade. What we're looking at here is something that they call asymmetrical compounding. And I'm just explaining it, so that doesn't matter. So we find another trade, which has a risk to reward ratio of 1 to 3 as well. But this time, instead of only risking $10, we're going to risk the $10 that we originally had plus the $30 that we just made. So we're actually risking $40, but potentially winning 3 times that. So potentially winning 120. Okay. So guess what? We won again. So we just won $120. Now, if we had lost this trade, we would have lost the $30 we won on the previous trade and the $10 we were risking there. So all up, we would, even if we lost this second trade, all up, we would only be down 1%. We would be down 1% still. But for argument's sake, we did win this trade, so we just won 120. So let's do it again. Find a trade with a risk to reward of 1 to 3. But this time we're going to not only risk that $10, we're going to risk the 120 we just made. So we're risking 130. At 3 to 1, that would mean if we win this trade, it would be $390. So if you can win 3 trades in a row doing that, you'd win 390, 120 plus 30. So that's $540, which is 54% of your original $1,000 account balance. So that's how in 3 trades you could, make 54% profit, increase your account balance by 54%. Now, I'm not saying it's easy to win 3 big trades like this in a row, but definitely doable with a bit of practice. If you know what you're doing, even if you know what you're doing, you might not get it to work out all the time, but this is a huge profit. Like for example, a lot of my trading, with my big accounts where I'm looking after them, that if I can make, 3%, maybe 5% profit for the week, that's a really good week. But we're looking at making 54% in only 3 trades. Now, if the third trade, if we had have lost this trade, we would have lost 120 plus the 10%, plus the 120 we just made, plus the $10, the original 1%. We would have lost $130. So we would have lost that and 10 of that. So we still would be $20 up. So even if we lose the third trade, we're still 2% up, which is fine. That's just another little way we can, use the risk to reward ratio to, as I said, they call it asymmetrical compounding. I don't really know why, but it sounds technical, so I thought I'd use it. But I think, And I did a little video up a while ago. I'll put that on the same playlist as this, I think. But that's just a really interesting and, in my opinion, fairly exciting thing to play with. Just, you know, you can probably guess 3 trades in a row if you tried hard enough. And it doesn't matter if you miss, as I said, if you lose this trade, if you lose this first trade, you're down 1%. Oops, 1%. If you lose the second trade, you're only down 1% still. If you lose the third trade, then you're actually up 2%. So at no stage in this, in no stage, at any stage, have you had more than 1% of your account at risk. But you're potentially making 54%. That's why I think this is pretty exciting. And if you, let's say the first time you tried to do this, we'll just start a new box here. First time you try to do it, you lose the first trade, okay? So you're down 1%. So you start again, we try again. Second time we try, we win the first trade, and then we lose the second trade. Win the first trade, lose the second trade. So we're down another 1%. So that means all up, we're down 2%. So let's try again. We win the first trade, we win the second trade, but then we lose the third trade. But that gives us 2%. So now we're back to even. So we've tried to pull this off 3 times now. Excuse my computer making noises, but we've tried to do it 3 times and haven't managed to do it 3 times in a row, but we've still just broken even on it. Now let's say we try a whole heap more times. Okay, we try another 7 times, and we end up, let's say in those 7 times we either get this one or this one wrong. That would mean we'd be down 7%. Then next time, so we've tried 7, 8, we've tried 10 times now to pull this 3 in a row off, and every time we fail. So we're down 7%. But then on the 11th time, let's say, bang, we get it. We win 3 in a row. We've just made 54%. So now we are 47% up. So it was still well and truly worthwhile. We still made a huge result out of that. So that's asymmetrical compounding. I just thought I'd throw that in because I find it quite exciting. Any questions on that?
Well, it seems to me like it's better to use the crypto platform rather than an MT4 platform where you're risking basically you can't pick say $10 to trade out of 1,000. You're actually going to be trading with your full 1,000 on the MT4, aren't you?
No, not really. Like, you can still do all this. Asymmetrical compounding is something that I come across in relation to Forex trading. I mean, it can be with crypto as well. It just means that if you're on an MT4, let's say you've got a $1,000 account, then you need to put your stop loss in a position where it would only be a $10 loss. So you're still only risking $10, so 1%.
Okay.
Yeah, so it doesn't really matter for that, it doesn't matter what leverage you're on, what platform you're on. You just need to have a stop loss in place, which will cap your loss at 1% or whatever percentage you'd like to work on. But, if it's, as I say, if you're getting really good at trading and you've got a setup that's just ticking all the boxes, you're in an uptrend, it's just bounced off the bottom trend line, which was also on support, and you get a big bullish engulfing, everything's just, all the stars have lined up, then probably go with risking more than 1% because it's a much closer to a sure thing. If on the other hand, it's just, it looks okay, it's only got 2 things indicating that it's going to go up, then maybe you just risk 0.5%. So you can choose that risk level based off your own level of experience to start with, and also of how certain you are of the TA you've done. So how certain you are of what the market's going to get up to. Oops. But yeah, so just sort of to sum that up, I think it doesn't really matter what your risk tolerance is or what sort of trading you're doing. It doesn't matter whether you're willing to risk 10% of your account on every trade or 100% of your account on any trade, or whether you're doing what I was just suggesting here and only risking 1%. You still should know what you're risking. You shouldn't just go and place a trade and hope it plays out. You know, like you shouldn't just say, oh, I'll put $100 on this trade, or I'll put a 1.5 lot size on this trade, depending on what platform you're on, and see how it goes. You should know exactly how much of your account you're risking on each trade, so that you know, just so you know. Otherwise, you're probably going to end up risking more than you want to, or you might have a really good trade set up, and you know, in that case, you should probably be risking more because you're fairly certain it's going to turn out in your favour. So, really, I just wanted everyone to be aware. I mean, there's a whole heap of different scenarios and stuff that I've done and learnt about risk, you know, risk management and risk to reward ratios. But I just want everyone to understand that it's something that's very important, and you should understand how to calculate it all out, at least roughly, before you even place a trade. Otherwise, you're not really following a nice, tight, neat plan. You don't know how much you're risking, how much you're going to potentially making. You're just having a punt at the races, really. Anyway.
Yeah, that's about right.
Yeah, no, I mean, I'm not saying that I always follow my trade plan or that I always do what I say that you should do, but you should be doing what I say, not what I do. But no, it definitely, I'm not the world's best trader by any means, but whenever I lose a trade, sometimes it's just, you know, you can't win them all, but the majority of the trades I lose, I know exactly what I've done wrong. So even though I still lost it, at least I know what I did wrong. You know, I jumped in too early. I didn't do the right TA. I was revenge trading or something like that. So if, you know, I know what I've got to work on as a trader. So that's what you should try. That's why a trading journal is good, why people always recommend a trading journal, just so you can look back and go, okay, every time I lost, like 90% of the time when I lost a trade, it was because I didn't wait for full confirmation before placing it, or because, you know, because I was in a bad frame of mind, or I was doing it when I was too tired, or after I come home from a night on the piss or something like that. You can sort of look back on your journal and work out what you were doing wrong. Not that that's got anything to do with risk to reward. I guess if you're coming home and trading drunk, then I guess that is something to do with risk. Not in a good way. All righty. That should do us on risk to reward, guys. So I'll press stop.